Did you know that just by watching the videos on this channel, you are making the world a better place? That's right. Every video you watch helps bring high-speed internet connectivity to remote communities around the world that are in need. Every view, like, comment, and share counts towards making our goal of worldwide internet connectivity a reality. So please join us in our mission to connect the world by sharing our content and becoming a subscriber today, because together we can make the world a better place. Hey everyone, is a new bull market taking shape? Is the yield curve wrong this time? We have a ton to unpack this quarter with an upward surge of an AI stock rally, updates on the yield curve, savings rates, and other data we regularly follow. Let's get into it. Welcome to Investing Made Simple. I'm Joe Macek, Portfolio Manager and Investment Advisor with IA Private Wealth, providing fully licensed and trusted investment guidance for more than 23 years. The second quarter of 2023 was very interesting to say the least, as we have what I believe to be a market that is developing very similarly to the 2008 markets, a yield curve that remains deeply inverted, a not so new AI revolution that's taking shape, and of course, I will be going through my forecast for the next little while. However, just a quick note, if you do have any questions about the content on my channel or questions surrounding your personal circumstances, please feel free to reach out to me with no obligation, as my details are now provided in the description below. We start off this quarter's review with a hard look at the NASDAQ 100, a key index for technology stocks that experienced a staggering rise of approximately 37% since the beginning of the year. This surge can pretty much be solely attributed to the growing excitement among investors regarding the potential widespread adoption of artificial intelligence. Tech giants such as Google, Microsoft, Nvidia, recognized for their strong positioning within the AI revolution, have played a critical role in leading this rally. Their stocks have soared and in turn have contributed significantly to the overall performance of certain benchmark indexes such as the S&P 500 and the NASDAQ. However, despite the mania surrounding AI and its impact on the market, a number of market experts have expressed some concerns about the sustainability of this equity market rally. The fact that the majority of the gains are concentrated within the technology sector and that a small number of companies within that sector are doing all the heavy lifting is what many experts are worried about. During a recent interview with CNBC, Scott Cronert from Citi highlighted the euphoria surrounding AI as the driving force behind the growth in the market. He emphasized that it is the excitement around AI that has been propelling this upward trend within a very narrow range of stocks, and there could be a digestion phase in the near future.
Well, I think we've got the euphoria around AI. It's driven the growth component of the market, whether it's the NASDAQ components or whether it's our broader growth cluster. You're looking at a 33% gain year to date. This is relative to the cyclical side of the market, which is down 1%, and defensive's down 4 to 5%. So this is not a broader market move. This is a very narrow move, if you will, from that perspective. It's predicated on long-term promise, where our concern is that that long-term promise isn't yet showing up in the fundamentals. It'll take some time for that to happen. We think it'll happen, but between here and there, we think we're probably setting up for a bit of a digestion phase during the second half.
When we look at the broader market and compare performances between indexes like the Russell 2000, the Wilshire 5000, the Vanguard Total Stock Market Index, and the S&P 500 X Technology, these indexes, while up modestly, have not even come close to the approximately 37% return the NASDAQ has enjoyed since the beginning of the year. To give you a really good perspective of just how much of an influence AI has been over the S&P 500, I now will refer you to this awesome short video courtesy of James Eagle, which shows an animated chart of AI versus the S&P 500 and the S&P 500 X AI. And of course, with the recent run-up, the majority of Wall Street investors now believe stocks have entered a new bull market and the US economy will skirt a recession in 2023, according to the new CNBC Delivering Alpha investor survey. CNBC polled about 400 chief investment officers, equity strategists, portfolio managers, and CNBC contributors who manage money about where they stood on the markets for the third quarter and forward. They found that 61% of the respondents believe that the market market has entered a new bull run, while 39% still think this is a bear market rally. Technically speaking, some market analysts have already declared the beginning of a brand new bull market for the S&P 500. This declaration is based on the simplistic standard of the index closing up 20% from its lowest point during the previous bear market, which occurred in October. However, it's important to note that not all investors share this sentiment. Many investors prefer to wait until the S&P 500 reaches a new all-time high before considering the bear market officially over. As for me, I don't really get caught up in whether bull markets or bear markets officially start and stop. I'm not an optimist, nor am I a pessimist. I'm a realist, and I follow the yield curve. And while the yield curve is inverted, I am in the camp that while this rally seems strong and is quite impressive off the October lows, this is very likely to be another bear market rally for the following reasons. First and foremost, as I've just mentioned, we have a deeply inverted yield curve. The deepest inversion I have ever seen in my career. In fact, the deepest inversion most experts have seen in their careers dating back to the early 1980s. The 10-year minus the 3-month yield on June 30th of this year was minus 1.62%, or negative 162 basis points. However, the yield curve did hit its lowest points on May 4th and on June 1st of negative 1.89% or negative 189 basis points. This negative spread between the 3-month and the 10-year is absolutely unprecedented. Even the inversion prior to the Great Recession was quote unquote only 64 basis points negative, which is roughly 1/3 of the all-time low today. The bond market is clearly signaling a recession is on the horizon, although the horizon may be a bit further in the distance than we are used to due to the savings rates left over from the pandemic, as I had mentioned in previous market commentaries. With that said, this market seems to be similar in nature to the 2007-2008 market for a few reasons. While we do not have the excessive lending in the housing market that led to the collapse in 2009, we do have what I think is a similar long lead time from the initial inversion to the recession materializing. When we go back and examine when the yield curve first inverted, during that time frame, it was January 17th, 2006. The recession didn't fully materialize until December 1st, 2007, 22 months and 14 days later. This is almost 2 years later. Meanwhile, the S&P 500 continued to rise after the inversion and peaked October 9th, 2007 at 1,565.15 points, just over 18 months after the first signs of the recession were signaled by the yield curve. Over the next approximately 17 months, the markets deteriorated and eventually collapsed, with the S&P 500 falling to a low of 676.53 points, a drawdown of 56.78% over that time frame. Given the fact that the yield curve can signal recession upwards of 23 to 24 months in advance of it actually happening, it would lend a lot of support to the argument that it is far too soon to say it won't happen. And at the time of this writing, we are approximately 9 months in from the yield curve first signaling the inversion. Fairly early if compared to the 2006 to 2009 timeframe. And history would show that we still could have plenty of time for a recession and subsequent collapse to materialize. For those interested in learning more about the amazing predictive power of the yield curve, please feel free to view my video on this topic. This is the ultimate indicator of collapse, where we examine the yield curve in greater detail. This brings me to my second reason I am skeptical of a new bull market forming. Similar to 2008 in Canada, and for the reasons Scott Cronert highlighted earlier in the CNBC clip, bull markets typically need broad market participation to be validated. The concentrated performance of the oil sector within the Canadian market in 2008 vis-a-vis the rest of the world is very similar to what we have happening in the tech sector today. While the S&P 500 and other global markets around the world started to deteriorate in 2007, the Canadian TSX Composite remained resilient up until the summer of 2008 due to oil prices remaining high and the index having a large concentration of oil companies within it. Many Canadians that were diversified outside of Canada at the time were puzzled as to why they were losing money in their portfolios while the markets they saw on TV were up, as they were not generally aware of the narrow concentration that the Canadian markets had. With that said, it really didn't matter for that long because as soon as the US recession hit, oil prices collapsed and the Canadian markets, being heavily concentrated in oil stocks, soon joined the global markets in the severe decline that followed into March of 2009. Finally, I know this isn't very scientific and I'm going to say something here that may throw you for a bit of a loop, but it just doesn't feel right.
Did you just say what I think you said?
Yep.
It just doesn't feel right.
The last really two bad markets we went through, and no, I do not consider 2020 a really bad market as it only lasted for about a month. Bull markets that I've experienced didn't start on feelings of hope or beliefs that the markets will get better soon or any other optimistic thoughts. The 2003 and 2009 bull markets started when the vast majority of investors completely lost faith in the markets and genuinely believed that stock markets would never appreciate again. It would be very common for investors to say around that time frame,
"This disaster is absolutely unprecedented,
and
it will be decades before we see the markets come back to their higher levels."
bull markets usually start on complete capitulation, maximum pessimism, and utter hopelessness. It's common for many investors to completely sell out, lose all faith in the process of investing, and some investors are so scarred emotionally, they never get back into the stock markets again. In my humble opinion, we just haven't seen this type of capitulation during the October lows. The third and most compelling reason I think this is yet another bear market rally is the Fed and their stance on inflation. The Federal Reserve is still quite hawkish on its stance, albeit less so. The Fed finally paused their aggressive rate hike policy in June, when at the end of their meeting, they decided to keep interest rates at the current levels. However, many anticipate another hike from the Fed in July, and fewer experts are seeing rate cuts happening anytime soon. Personal savings rates are still below 5%, a headwind we detailed in the Q1 market commentary, and checkable deposits seem to be coming down from the peak as well. However, there is still a large amount of savings in the system that need to be worked through. So to sum it all up, the bond markets with a yield curve inversion, and not just any inversion, but the deepest inversion we have seen in many years, are telling you that there is trouble still on the horizon. Investing your money contrary to the predictive nature of the yield curve has not been very wise to do over time, as the yield curve has been an exceptionally correct indicator over the long term. Market breadth and sentiment is still not good, and as if that weren't enough, we are still in the later rounds of an aggressive Federal Reserve that has hiked rates substantially in the last 12 months. Fighting the Fed, especially now in the later rounds, has also not been wise to do in the past. The recent rally is basically an AI tech stock rally fueled by irrational exuberance in a narrow area and can revert back to the mean sooner than we think. Fear can grip markets in an instant, and indiscriminate selling can take stocks to unprecedented lows no one would think possible. We saw this in 2000, in 2008, briefly in 2020, and we could see it again this year or into 2024. Now, this is not to say that there isn't amazing growth to be seen in the AI sector. I just think it will take a little bit more time to develop, similar to when e-commerce was introduced in early 2000. Of course, anything can happen, and it will be interesting to see what develops, but as of today, I'm firmly in the recession camp. So how can you use this commentary? Well, our viewpoints remain very similar to the last quarter. If you're an investor who has many years until retirement, you might find the upcoming 12 to 18 months to be an excellent time to invest. With likely little invested capital, it's probable that you will experience frequent down days and market sales. If you've taken advantage of the dips during the last quarter, continue to do so by focusing on buying opportunities instead of short-term performance. You'll probably see a lot of great deals on a lot of outstanding companies over the next little while, and despite the possibility of more sell-offs on the horizon, keep buying on red days and dips. It may be disheartening to see fresh money invested in the market time and time again, only to see it decline. But in the long run, you'll probably be glad you added as much money as you did during the downtimes. On the other hand, if you're nearing retirement or in the early stages of retirement, this may be a more challenging time to navigate mentally and emotionally. It is likely that you have a significant amount of capital invested and no means to replenish the affected principal. You may want to prioritize preserving your capital at this point if you haven't already. If you've reduced your equity exposure over the last quarter, continue to do so during any market rallies and reevaluate your portfolio for any volatile or high-risk positions. Now would be an excellent time to consider reducing them and investing in alternatives with a proven track record during challenging times. Our clients have once again performed very well during this period, and we have taken advantage of several opportunities this year to sell into rallies and safeguard additional capital in our discretionary portfolios. By adding additional holdings to our alternative sleeves and private equity, we have seen lower volatility and provided better risk-adjusted returns. Well, that's it for this quarter, and until next time, this is Joe Macek for Investing Made Simple. See you soon.